And welcome back. In this session, we're going to start to take a look at capital market expectations. This is the first of a two-part set of videos where we cover some of the material from Chapter 4 in the McGinn textbook. In this session, the first part, we're going to focus principally on data and modeling limitations, business and inventory cycles. We'll take a look at some of the phases in business and inventory cycles and how we read those cycles, and also inflation and the business cycle, some of the modeling tools that go along with that. Our expectations of capital markets are based on investors' expectations of what will come next. We start off with a basic presumption that a lot of the return, perhaps 3/4 of the source of return from a variety of different kinds of assets, comes from the market. We've heard the term that a rising tide lifts all the boats, and by the same from the same expression, when the tide is out, obviously that's going to have a negative effect on companies. So we want to know what's happening in the bigger environment, the macro environment, before we start to take a look at what's going to affect some of those individual assets. That means we have to start off by determining or by guessing what's going to happen in markets before we start to think about our asset allocation, something that's covered in the next part of the course. Our framework for capital market expectations starts off with a variety of steps, or with steps that are listed here. First, we have to specify expectations, especially within a certain time horizon. What do we think is going to happen for the next 3 years, the next 5 years? Of course, we start off by taking a look at the recent past and trying to understand what has happened in order to predict what will happen. Then we're going to determine the kind of models that will be used for prediction. We'll look at data sources. We'll try to interpret the current investment environment using the existing set of tools, our existing models and methods, adjusting those for our own experience and our own expertise. And then from this, we're going to try to produce a set of expectations. What do we think will happen in the next year, the next 2 years, the next 3 years? A great example of this comes from the annual meeting of the Chartered Financial Analyst chapter in Vancouver, where everyone sits around at dinner, and some of the best analysts in Vancouver will stand up on stage and say where we think will be the next year, what will happen to the indexes, what will happen to the economy, what will happen to the price of gold and a couple of other commodities. At the end of this, they'll sit down, and then a year later, they come and stand up in front of the same dinner, and everybody laughs because we get to find out how wrong they were. It doesn't matter. Predictions are always just that. They're predictions. They're not guaranteed to come true, and quite often the best of us do know better than the average, but we still have to try. After we've made our predictions, the next stage is to monitor them, what actually happened, and try to improve on our models so that in our subsequent predictions we'll do better. You can see examples of these predictions. They're published by all of the major banks. In this case, you'll see that on the VIU Learn website, I've posted a copy of the most recent version of the Royal Bank of Canada's predictions. This particular document takes a look at where we are now and some of the things that are likely to affect markets over the next while. Things like vaccines, for example. As of December, when this report was written, it predicts that the rate of vaccination might actually have a significant effect on what happens in markets. Of course, all kinds of modelings have limitations, and to be aware of those limitations is one of the most important parts of being a user of that information. We have to understand the construction of models, how they're created, the timelines, the limits to accuracy, and especially any of the biases, any of the systematic mistakes that we make when we're producing these models. And we'll look at these as well in the next couple of slides. The time difference may be part of our mistake or error, time lags. The data themselves may be mistaken. For example, we will announce perhaps 2 months after the end of a quarter what we think the GDP growth was. But 6 months and 9 months after that data is collected, we'll revise it because there are errors in our sampling that are only apparent with time. Some of the definitions may change. The way that we define inflation depends on what we buy, and the kind of things that we buy change over time. We didn't buy a lot of computers in the 1960s. We didn't buy a lot of certain kinds of services like internet streaming. So those had to be added to our basket of goods to understand what inflation looked like. So definitions might change. We might also change the index or the weightings that we use for different kinds of things that we purchase or different kinds of things that we're measuring. So the basis for the creation of a lot of the indices might change, and that includes things like equity markets. Some of the errors or biases that we systematically make, in other words, we can predictably be wrong with, include things like just gathering and recording data. Censuses are a great example of that, because every few years we have to figure out what our market looks like by reevaluating the census, reevaluating the nature of our participation in the economy. We also have got something called survivorship bias. In other words, we measure the companies that still exist in the market, but we don't actually consider the ones that dropped out. Bankruptcies, failures, essentially mean that companies that were reporting last period don't report this period. And so by only looking at the successful companies, the survivors, we're always being a little bit more optimistic than we probably should be. If you consider the nature of a fourth-year undergraduate course, the people that are in the room with you are the people that survived the first, second, and third years. And so on average, fourth-year students are expected to be smarter than first-year students because of that survivorship bias. We also have got smoothing of data. In other words, by aggregation, by collecting information, and by combining it, we're actually taking out some of the extreme values. And so if we test something 4 or 5 times, we end up with a smoother average than if we only tested once. And so that may also create a bias that we will not observe in the next set of information. There are also limitations that we have with historical information. Things that happen in the future could be significantly different than the way that things worked in the past. Technology changes, we have changes in the political landscape, legal, regulatory environments. There can also be periodic events like a financial collapse or a war or a catastrophe. Things like that basically mean that the future may not be a fair representation of the past. It might not look like the past. Things like this mean that the data itself is not going to be part of a predictable line. In other words, that non-stationarity, that information from the past not being able to predict the future, may be part of what we're going to have to deal with. In order to be able to produce a long-term view of the past, in order to predict the near future, non-stationarity might be a major factor. The past might not be a predictor of the future, at least not an effective one. And that's where we start to talk about ex post, or looking at the past, in order to be able to predict the future, the ex ante. And so the risk in the future might not be entirely driven by the history from the past. If we saw a 12% standard deviation over the last 5 years, our presumption would be that the standard deviation of an asset class might also be 12% next year. However, a lot of things could be different in the future. There could be a structural change, a change in tax rules, there could be a change in government and so on, that means the past might not be an effective predictor of the future. So all of these things are put together in order to consider whether or not our predictive capacity is really going to be significant. We also have other types of significant biases, and this is the list that I'm talking about today is not exhaustive. There are a lot of different kinds of things that can affect or that can create biases that essentially mean that we systematically make mistakes. Data mining is essentially an exercise that is produced by many, in fact, by most analysts, when they start to take a look at a series of information and select the data that they like the best. As we have more and more data sources, it becomes easier and easier to find a data source that confirms our own bias. We think that things should be heading this way. Look, that's what the data tells us. In terms of social media, we talk about bubbles. We tend to listen to people more carefully when they confirm what we expected to hear. And so this is just another example of that. There's also a problem with following trends when time itself might not be smooth, that non-stationarity that I talked about. For example, if we go through a 4-year election cycle and we see a certain trend emerging, we would presume that things are going to be the same in the next year or two, but in the next regime, as we go through, as we have a new government, that stationarity might not exist. So there may be a time period bias. Business cycles also influence that. If we had a financial collapse, we might see a downward trend, and we don't necessarily expect that downward trend to continue as we move into a longer cycle. There's also a certain amount of smoothing that is built into the analysis that we use. New information means that using smoothing does not really work. If we have new data, if there's going to be some new facts that are entered into the model, perhaps we're going to have to adjust the data. A significant tax regime change, a change in capital gains tax rates, for example, would have a huge knock-on effect and would mean that historical information would have to be conditioned or improved for that new information. Change from, for example, in the UK, from the EU system to a Brexit system means that future growth patterns have to be conditioned for that new information. We also have got significant misinterpretation of cause and effect. Causality and correlation. You've heard about that before. If you see that things happen and two things always seem to happen together, we assume that A causes B, that there is a causal relationship between one thing and another. It's quite possible that a third factor, a hidden variable, might actually be a more important proximal cause of that event, and we're not able to observe it because it happens outside of our view. We notice that two people come in late together, and they're always coming in late and together. We assume that person A is causing person B to be late. What we don't observe is that they both take a bus, and the bus, which is not observable from the classroom, typically arrives 5 minutes after class starts. So A is not causing B to be late, B is not causing A to be late, but C, the bus that we don't observe, is the actual cause, the hidden variable. And that is very common. And we can't actually work with the A-B relationship until we understand about C. So causality and correlation, an important type of predictive error that we make. So unless a model can account for all of the variables, both the obvious variables and the hidden variables, we don't have a model that works. The more information we have, the better our models are. That's why we talk about a multiple regression model that takes into account all of these factors, having the best predictive power. There are a number of other types of biases that we describe as behavioral or psychological traps. Some of these you may have run into before. One of them, of course, anchoring. Essentially, we tend to expect that certain information will predict the future. So if we will put more weight on the first bit of information that we receive on a particular topic. If somebody tells you that the investment markets are corrupt, then you will start off with a basic belief in that, and until you have a lot of additional evidence, you'll continue to believe that those markets are rigged. We have a tendency to expect that the status quo will always be the status quo. We look for evidence that's going to confirm our own bias, that confirmation bias. We look for evidence, or we put more weight on evidence that tends to confirm what we already believe. We have in order to take action, we have to have confidence. And for many people, that confidence itself tends to be a source of bias, overconfidence. A fear of making mistakes that is greater than the choice to make a gain. Excessive prudence may be another bias. And perhaps the things that happened most recently are going to be the things that are going to be the most significant for us. So that one event that burned us last week, that mistake we made last week, tends to be set in our mind most strongly. And so that creates a recency or a recallability type of bias. There are a number of uncertainties that come from modeling. First off, the model itself might not work. Secondly, the inputs to the model might not be effective. And those things together create a model that may or may not be an effective model. A number of the type of models that we use include statistical ones. And these start with our simple regression models or multivariate models. For these things, we need to have sample estimators. We need to have estimators that will help us to understand the change in the value of those estimators, the shrinkage estimators. There may be estimators that account for time, that are going to be serial in effect, that we observe that one thing happens after another. So there will be time series estimators and that serial correlation that we were discussing earlier. And we might have multivariable or multifactorial models that essentially say that one thing happens because two or three things are going to affect them. For example, in predicting insurance markets a few years ago, I helped to put together a model that actually determined that one of the variables that determines how much people spend on insurance is the value of their house, which at first didn't make sense, but in discussion with people in the markets, it eventually started to make a lot more sense. So those factors, what might not be immediately obvious, can eventually be major predictors. Some of the tools that we use that you're already largely aware of include things like discounted cash flow approach, essentially saying the present value of an asset or an asset class is X based on the following information, based on the stream of cash flows that we expect to gain. Of course, that's also linked indirectly to risk premium. What kind of premium do you expect on top of a risk-free rate of return in order to invest in that riskier class of assets? And financial market equilibrium essentially ignores those first two things and says that we look at risk and return, the supply and demand of assets in the market, probably because we expect that other people have done those first two things. They've looked at cash flows, they've looked at risk, and they've decided to invest more or less. For example, the price of gold exists at a certain level at a point in time because so many people want to buy, and at a certain price people are willing to sell. And so that equilibrium, supply and demand, sets the price. That may be related to risk premium. It may be related to the value in use or the cash flows. You can see the risk premium is actually published on a regular basis for equity markets in this case by one particular source that I use, and that's a Credit Suisse report that's published and republished every year by Dimson, Marsh, Staunton. And here it tells us that the expected rate of real return for all equities in a market over a very long period of time is about X%. And from this, if you take a look, you can see that over a little bit on the right-hand side of the diagram, you can see Canada in between Finland and Sweden. And we have about a 5.5% real return in Canadian dollars from our equity markets. That's the amount of return that you would expect to receive in excess of a risk-free rate. So if the risk-free rate is 2%, then you'd expect to earn 7%, 5% plus the 2% from your stock portfolio over a very long period of time. Of course, that's not year to year, not every year, and this year will be higher and next year may be lower, but on average, in this case, over a space of about 118 years, that's what the average has been for Canadian markets. We can also, as well as using those statistical models, we can use the expert opinions, a Delphic approach or a survey approach. We'll bring together the top analysts, the 5 top analysts, the 5 best economists from the 5 best investment banks, and we'll take a look at their opinion. What do they think will happen? Now, of course, they have biases, but we figure the average of all of their biases will give us a good answer. Of course, they can be wrong too, and they can't really predict the future. We can use an even bigger sample of our experts. In this case, we can use things like purchasing managers and inventory cycles. Companies will hold larger inventories when they expect things are going to go well. If your company, for example, makes electrical components and you need a lot of copper, companies tend to hold reserves of copper when they expect prices are going to rise. So at the beginning of a boom cycle, we'd expect to see those companies buying a lot of inventory. And inventories rise as they expect to sell more, but also because they know copper goes up in price as soon as the business cycle starts to take off. So that gives us an indicator that things are going to get better. If they expect that sales are going to fall, they're going to cut their inventory. And so we also see that their prices are going to be cut, their inventory gets run down. And then when sales pick up, they start to buy inventory again. And so by following those inventory cycles, which tend to be relatively short, 2 to 4 years. Business cycles tend to be longer than inventory cycles. They might run from 9 to 11 years, although the predictability of business cycles has become more difficult. You remember us talking earlier about booms and bust. At a recovery stage, we're at the bottom of a business cycle and things are starting to pick up. Production capacity outstrips demand, so we have excess production capacity or an output gap. Bond yields tend to be at the bottom. Stock markets are starting to take off, and adding risk starts to pay off. As the market starts to take off, we see growth in the economy, but no inflation because we still haven't filled that output gap. There's still more capacity, so prices aren't getting pushed up. We're starting to use industrial capacity. We're starting to add those second shifts in our factories. Short-term interest rates start to rise as central banks and the banking system starts to control the risk of inflation, but the rates are still pretty low. Later on in the upswing stage, as the market is starting to take off, but probably before it reaches that inflection point where growth increases at a slowing rate, the output gap starts to close. There's a risk of inflation, which is what we mean by overheating. Inflation may start to rise a little bit. That creates a higher nominal interest rate as the central banks are starting to account for that inflation and they raise interest rates. Stock markets are still going to do well, but we start to see volatility, and that's partly because of that inflection point, because of fear of falling growth. Then in the later part of the growth stage, we see a slowdown. So the economy grows, but at a decreasing rate. It's past that inflection point. It can be very sensitive to new information. If there's a bad bit of information, the market's a bit twitchy, we can see those corrections happening in the market. Interest rates are going to rise to their highest level because central banks are concerned about inflation and they're starting to slow the economy down because they don't want to create that overheating. Interest rate sensitive stocks tend to perform best at this point. Heavy good manufacturers, real estate businesses, banks, insurance companies tend to do really well in the late stages of an economic boom. And then, of course, we're going to reach the peak and move into some kind of recession. Our GDP falls, interest rates are going to be cut as central banks try to control interest rates. Bond yields fall as people try to hold on to those higher priced or higher coupon rate bonds. Stock market then can move into a bottom. It follows the real economy ahead of the business cycle recovery. That, in a nutshell, is the business cycle. Now, inflation tends to rise in the late stages of the business cycle as our output gap falls to nothing, as people compete to buy things, as people want more solid, tangible assets because they tend to hold their value well. And so that pushes up inflation. Inflation tends to fall during a recession as we have a rising output gap, and especially into the early recovery stages. Our challenge is to keep inflation low without causing the deflation or recession, and that's the role of the central banks and the monetary policy in the country. Our other concern, something we haven't seen a lot of in Canada, but we have in countries like, Japan, for example, deflation, essentially the opposite of inflation. It undermines debt-financed assets, for example, houses and cars, and central banks have little control in a deflationary cycle. Inflation affects different classes of assets differently. So cash, and by cash we mean money market instruments of short duration, things like treasury bills, other money market instruments. Inflation increases the nominal interest rates, so essentially the value of those short-term instruments goes up with inflation. Inflation erodes the par value or the terminal value of a bond, and also later fixed coupons that we're going to receive. So that essentially means that the inflation goes up, the real rate of return on bonds goes down. Stocks do best when we expect inflation, but they may do well or do badly when there is high inflation. That's because people want to hold something tangible. They don't want to keep their value in money. And companies that own buildings and plant and machinery tend to see their value go up. And companies that have got mostly monetary assets like banks and insurance companies may see their stock prices go down in high inflation. And real estate, of course, is the place where you want to have your money, gold, real estate, something tangible in an inflationary economy, because the dollar value, maybe not the real value, but the dollar value of hard assets goes up when the value of money goes down. Some of the factors that affect the business cycles tend to be driven by consumers. And that's why we talk about consumer spending and consumer activity. So they are about 60 or 70% of GDP, higher in countries like the United States, lower in centrally planned economies like China and Russia. So typically the consumer spending is the biggest factor. So we monitor retail sales and personal income when we're trying to predict economies. Businesses are a smaller part, but remember, businesses make significant discretionary decisions like holding inventory. So for that reason, we may look very carefully at changes in business purchasing. And government policy with respect to the supply of money is an important mechanism that will modulate the growth in the economy, perhaps used to increase economic growth in times of weakness. We see that for business confidence, we look at things like the Purchasing Managers Index or the Institute of Supply Management, and essentially this is a survey done on a regular basis of purchasing managers and their behavior and intentions. So if we see the increased purchasing from supply managers through the PMI or the Supply Institute for Supply Management, the ISM, then that is an indicator that the economy is going to be doing well. We look for that trend, and when there's a new announcement, often the markets react quickly. Or the PMI, in this case, the headline from the Royal Bank of Canada's website is the Purchasing Managers Index falls to a 4-month low. Well, essentially, there's a lack of confidence, and that's another indicator that the economy is turning down. Of course, in this case, I think they were wrong, but it was one of those tea leaves that we try to read. We also try to read the monetary policy predictions from the behavior of central banks. And so for this reason, everybody watches the central banks. We watch them directly by listening to the announcements from the governors of the central bank. Experts will watch the central banks, like the Royal Bank of Canada and all of the other banks will look at the central banks to try to divine what's happening. Individuals will express their opinions on what they think is going to happen in terms of monetary policy by investing in futures markets for interest rates and currencies as they try to predict what's going to happen in these markets. And of course, a new bit of news, the governor of the central bank says, well, we think something's going to happen, something's going to change, or perhaps nothing is going to change. As we speak, the chairman of the Federal Reserve in the United States, Jerome Powell, is telling us a little bit more about what he thinks is going to happen over the next few months. Probably not announcing a rate increase or rate decrease, but by predicting what's going to happen, giving people an indication of what to expect in terms of monetary policy. And everyone's hoping that we're going to have good news, and the stock market later today will react on that information. Now, central banks don't just grab a number out of the air. There's a long deliberative process, including voting by different governors of central banks. And they try not to surprise the market too much because they know how disruptive that information can be. There's a model produced by John Taylor that essentially says that central bankers look for two main bits of information, and that we can predict what they're going to say based on this information and the weighting that we put on this relative new information. I won't go into all of the details of this particular model, Taylor's model. Essentially, it says that we expect that interest rates are going to depend on inflation, that's that symbol pi, the real rate of return that's required. We require 1% or 2% rate of return, plus the weighted average of surprise in growth and the surprise level of inflation. And alpha in this case, we have alpha of pi, the alpha of inflation, the weight of inflation, and the alpha of y. And that's the weight that we put onto growth. And so here we compare what we actually observe and what we expect. And if there's going to be a big change, if it's 50-50 weight that's put onto the GDP growth and 50% weight that's put on inflation, then the size of a surprise will reflect what the central bankers are going to do. So we'll talk a little bit more about this, and this is something that's covered in much more detail in Chapter 4 in the textbook. The yield curve, the final tool we're going to look at in this video, is a very important and very complex topic that we only introduce here. Now, essentially, we know the yield curve is a measure of the tenor or the timing of interest rates. So we have overnight rates, 3-month, 6-month, 9-month, 1 year, 3-year, 5-year, 10-year, and so on, rates of interest. And generally, the longer the term, the higher the interest rate. Management of the yield curve essentially says, what do we think is going to happen in the short term and the long term? In the short term, interest rates typically are steep. And then in the long term, they tend to rise at a slower rate. This has all got to do with our time value of money. And sometimes the curve shifts up and down if there's new information about interest rates. This yield curve is partly managed by monetary policy by the central banks and the way that the banking system works. And it's also managed by the supply and demand relationship for each time period's instruments. If everybody wants to put their money into short-term treasury bills, they're going to bid up the cost of those short-term treasury bills. And if everybody wants to keep their money in short-term, nobody wants to put their money in long-term. We may actually see a downward sloping yield curve in the short term anyway, for the early time periods. I'm not going to get into this. We have fixed income courses that look specifically at some of those topics. But essentially we say that if the government policy, both fiscal, the legislated policy, tax policy, and the monetary policy are tight, economic growth is likely to slow. There's a tightening of money, we see. If we expect that the central banks and the government are going to loosen money, they're going to buy back lots of bonds, going to flood the economy with money, it tends to help the economy to grow. When we end up with different policies, perhaps a decrease, well, as we saw during the Trump era, tight money in the central bank in the early part, and cuts in tax rates, the results are ambiguous, although it did result in a significant improvement in equity markets. The yield curve then tends to reflect these policies. If we have loose policy, both short-term monetary policy and fiscal policy, we expect to see a steep yield curve. If we have both tight monetary and fiscal policy, we could actually see a downward sloping yield curve. The yield curve, of course, we've seen before, at least I hope we have. It's something that we talk about in most of our corporate finance courses. And you can see in this case, this is a stylized curve practically. It's exactly what we'd expect to see. Generally upward sloping, steeper in the early stages, but for longer periods of time, out to 30 years, generally flat. Typically not downward sloping, but in this case I think we had a shortage of 30-year bonds, which meant that we could see some downward sloping because we just didn't see enough transactions in those very long-term bonds. And of course they shift over time as we get new information. So in this particular chart from the Bank of Canada, in different periods in time, the curve moved up or down, a bit of a shift because of new information. Well, that has been an introduction to some of the basic macroeconomic factors and the modeling process we use. In the next video, we're going to talk a little bit more about how we do forecast things like growth. I'll talk to you soon.